Oh, all right, let's bring in from Niles Investment Management, founder, portfolio manager, Dan Niles. Dan, I know you're always concerned, and you certainly have some concerns right now, but you're also, if I read your note right, saying an accommodative Fed sort of supersedes all the concerns that are out there.
Yeah, unfortunately, Charles, that's the way it's been since COVID, you could argue, where unless you think a global pandemic is wonderful, the S&P was up 14% that year. And you can argue it's really been money supply since Lehman failed, all the way back in '08, that's really driven this market. And right now you have a Fed cutting again after 9 months where they didn't do anything, and you're not in a recession. And those are terrific times to own stocks. And everything pretty much goes up. But if you look at this since the Fed resumed cutting, so from the night of September 16th close, right, the Fed cut the next day. Since then, the S&P is up 1.9%, but the Russell is up 3.5%. The Magnificent Seven, they're actually down 20 basis points. So what you have is the Fed spiking the punch bowl, as I said, and you just said now, but it's driving up all sectors of the market. The rally is broadening, and I think that's what investors need to think about. Now, at some point, I think this is going to end horrifically badly next year when the Fed is done with the new round of cuts. But for right now, you want to enjoy the party.
So let's talk about the Mag 7 then, because they really have sort of been individual names more recently, right? They've sort of traded on their own, not necessarily as a collective. You sent some notes about them individually. Which ones do you like here? Are there still some that are viable buys at this moment?
Yeah, no, I think they're all actually going to have some pretty good results with the exception of Tesla's guidance. If you look at the other six of them, the two that I like the best are right now, it's Amazon. And why is that? Well, the stock is dead flat for the year, which is pretty poor relative to the S&P, which is up 14%, and the Magnificent Seven on average, which are up 17%. And there's a good reason for it. Their AI story has been the worst of the hyperscalers. Their Amazon Web Services grew 17% in the March quarter. It was stuck at 17% growth in the June quarter. If you look at Google, their revenue growth for Google Cloud accelerated from 28% growth to 32%. And Microsoft, which hosts OpenAI on its infrastructure, Azure for them grew from 33% in March, it accelerated to 39% in June. I think what you have with Amazon, though, is they also are the host for Anthropic. And Anthropic has become the coding assistant of choice in the AI world. And Anthropic's revenues were about $1 billion in annualized run rate revenues at the beginning of the year. In August, that was up to about $5 billion. And by the end of the year, it's probably closer to $9 billion. And so you're going to see that go from contributing 1 to 2 points of growth in the first half of the year to probably closer to 4 to 5 points of growth in the back half of the year, and that should get AWS going again. And obviously e-commerce is doing well, and they're striking new ad deals like the one with Netflix. That'll help them also. And then with NVIDIA, it's two very simple things. One, NVIDIA invested in Intel, which obviously the US government cares about deeply. I think they'll get, as a result of that, NVIDIA will get the rights to ship a version of Blackwell to China imminently. And the second thing is all these circular investments, which right now people are willing to give companies the credit for, like NVIDIA did with OpenAI for $100 billion, that's not in the numbers. So both of those things should result in estimates getting revised higher and analysts, reiterating their buy ratings. And if you look at the multiple for the growth rate it's at, it looks very reasonable. And for right now, people want to believe, and I think that'll keep the stock moving to new highs.
Let's talk about, you've got an RFID investment idea you want to share with us.
Yeah, and I think you and I actually might have talked about it for the first time ever on TV back in 2023, but it's called Impinj. And if you look at where the world is today, right, everybody's trying to figure out how to automate things and how to use AI most efficiently to run their businesses. And with RFID technology, I think it's a technology whose time has come. It's been kicking around since the 1970s. Internet technology, AI technology has been kicking around since the 50s and 60s, and obviously they've had their day in the sun. With RFID, now you've got costs now down to about 2 cents per tag or inlay, as you call it. And now that means you can get into huge markets like food and drink packaging, whereas today it's really used to tag things like apparel, clothing,
Right.
which is an 80 billion unit market. Food and drink packaging, that's about a 1 trillion plus unit market. And I think Impinj is right at the heart of that. They're the market share leader. And I think RFID is something you're going to hear a lot more about next year.
Hey, before I let you go, Dan, I know you have sort of a caution for investors with respect to focusing on individual stocks. Is now not the time to be a stock picker?
Yeah, I think, as I said earlier, right, the Magnificent Seven are actually down since the Fed
Right.
cut rates, right? The Russell is up 3.5%. So if you're in the camp that I am, where this is all being driven by this Fed, spiking the punch bowl, everybody's feeling great as they're consuming all this alcohol and stimulus, but eventually there's going to be a hangover. And so I think for right now, if you want to be, as I call it, prudently irrational, because I think that's where the market is, you want to be very well diversified across market caps, across stocks, because the market's just going to rotate from sector to sector to sector as all of this alcohol keeps getting dumped into the market. And being broadly diversified, I think, is the best place to be, because the market's getting riskier as it goes up because the multiples keep going up.
Well, that's the story of my life. Prudently, prudently irrational. I think you described me in a nutshell. Hey, Dan, thank you so much, my friend. Have a great weekend.